Hello and welcome back to the channel, your go-to source for understanding the complex world of hard-to-borrow stocks and potential short squeezes. Today, we're diving deep into BIYA, ticker symbol BIYA, a micro-cap stock that recently appeared on our proprietary hard-to-borrow screener. We'll break down exactly what makes BIYA stand out, what the data suggests, and what you need to know about its unique situation. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a snapshot of BIYA. This is a micro-cap company whose sector is currently not broadly categorized. Our data indicates an estimated float of 2.7 million shares. Now, for the recent trading action, looking at the last 30 days, BIYA has seen a 0.0% change in price, with today also reflecting a 0.0% change. Even over the last 5 days, the price change stands at 0.0%. The volume data tells a similar story. Today's volume is 0 shares, the 30-day average volume is 0 shares, resulting in a relative volume of 0x average. This is critical context as we discuss its hard-to-borrow status. BIYA basic stats on screen. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? When short sellers want to bet against a stock, they first need to borrow shares, usually from institutional investors, to sell them on the open market. They hope to buy those shares back later at a lower price, returning them to the lender and profiting from the difference. The CTB is the annualized interest rate short sellers pay to borrow those shares. It's essentially the supply and demand for borrowable shares. If a stock is hard to borrow, it means few shares are available, driving up this fee. Fees can indeed exceed 100% annually, sometimes even much higher, indicating extreme demand or scarcity. Why this stock is hard to borrow right now? Now for BIYA. Our screener flagged it due to an exceptionally high annualized cost to borrow fee of 773.1%. Highlight CTB fee on screen. That's a staggering figure, indicating a very high cost for anyone looking to maintain a short position in BIYA. We don't have CTB momentum data or the exact number of shares currently available to borrow, but this high fee strongly suggests scarcity. Our composite squeeze score, which factors in multiple metrics like CTB, foot size, and technicals, currently gives BIYA a score of 41.0 out of 100. Despite the impressive CTB, it's important to remember that BIYA's current 0 volume and 0 price change means there's virtually no trading activity to speak of at present. Squeeze mechanics explained. A short squeeze happens when a heavily shorted stock suddenly starts to rally. As the price goes up, short sellers, who are now facing increasing losses and potentially margin calls, are forced to buy back shares to close their positions. This forced buying creates even more demand, driving the price higher, which can then trigger a cascade of further short covering, creating a squeeze. For this to occur, you typically need significant trading volume and price momentum. In the case of BIYA, while the high CTB indicates a potential cost pressure on any existing shorts, the current lack of any trading volume or price movement means the necessary conditions for a squeeze are not currently present. Dilution risk check. One crucial factor we always examine for potential short squeeze candidates is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can dilute the value of existing shares and often give short sellers an opportunity to cover their positions without triggering a squeeze as new supply becomes available. For BIYA, our checks found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. We also found no recent reverse splits for BIYA. This absence of recent dilution is generally a positive sign for a short squeeze thesis, as it means new shares aren't actively being added to the market, which could otherwise offset any upward price pressure from short covering. Before we continue, here's that important reminder again. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given BIYA's extremely high cost to borrow, coupled with its current 0 volume and static price, the key thing to watch for is a change in trading activity. While the high CTB suggests any existing short positions are expensive to maintain, a short squeeze cannot occur without actual trading. We would need to see a sudden surge in volume and significant price movement for the squeeze mechanics to even begin to activate. Without that, the high CTB for BIYA is a theoretical pressure point rather than an active catalyst. Remember, a high cost to borrow doesn't guarantee a squeeze. It can also indicate that short sellers have very strong conviction and are willing to pay a premium to stay short, or simply that the stock is extremely liquid. So there you have it, a detailed look at BIYA and why its incredible 773.1% annualized cost to borrow has caught our attention. While the CTB is certainly eye-catching, remember the crucial context of zero trading volume and static price action. We'll be keeping an eye on BIYA, and if its trading dynamics ever shift, we'll be here to analyze it for you. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments what other hard-to-borrow stocks you'd like us to cover.